Three of the four big banks have just reported their earnings, and there's some burning questions that have come out of it. We've got some of the smartest minds in Australia to answer those questions. Omkar, three of the big four banks just delivered their earnings reports. Anything impress you?
I think the key thing that impressed us was really the focus on cost out. So ANZ in particular reduced its headcount by 5% in the last 12 months, and that's quite an impressive target to actually achieve. I guess Westpac was probably a laggard on that front, but I guess given the results, there wasn't really much outstanding out of them. But cost out was probably the biggest thing.
Probably the most impressive thing was positive jaws coming out of the banks. Despite bad debts ticking up and corporate debts ticking up as well, positive jaws is a really good result.
Two things, Matthew. Positive jaws, so which mainly sort of cost control, was a bit better than we expected, and expanding net interest margins. So it's banks repricing their back book, increasing their rates, and not pricing through the full amount of cuts.
Okay, there's always a few concerns to come out of results. Yeah. What concerned you most about them?
Concern was just the trajectory of rising bad debts. All of the banks are facing larger single names, and a range of some banks are facing up to them, some are not. We were quite surprised to see that NAB didn't take it through the full range of their exposures to Slater and Gordon, whereas Westpac took through exposure to that. I mean, that's a factor of the compressed reporting season. Normally in these reporting seasons, they get to have a look at each other's results. With this compressed into 1 week, they didn't get a chance to look at it.
Well, I guess the key things that concern us from here is really capital levels going forward, and it's pretty clear that capital's still going up. APRA hasn't really finalised what it's doing there, but it's pretty clear that it has to go up from here. Bad debts is probably the other piece that does actually concern us at this point in time as well, just given that the economy is getting worse. And we're probably at the low end in terms of bad debts, cyclical low. If anything, it goes up from here. And margins weren't that great either. And so funding cost pressures are still well and truly rife. So in the current environment, the banks don't really have much pricing power. We've got the election coming up, etc. So in that environment, it's probably likely the margins still be under pressure as well.
I guess the biggest concern out of the bank's results was the commentary on pockets of weakness. We think this is the start of a trend coming over the next 12 to 18 months. That bad debts will tick up over that period.
And the market's been pretty negative on banks for about 12 months now. Been a little bit better in the last couple of weeks. Are we too negative? Have valuations got too low?
I don't think so. The banks are facing both structural and cyclical headwinds, so I think the market is pricing them appropriately at this point in time.
I don't actually think they are too negative at this point in time. So we've actually had a decent rally in the share prices over the last couple of weeks. And so I guess at this point in time, we're probably actually factoring in a lot of the positives and probably not factoring enough of the potential negatives.
I think looking here, there'll be an immense amount of retail support for the banks. Across the sector, they're trading at a 6.6 premium to the TD rate. That will provide the support. But fundamentally, they don't look sort of that amazingly exciting going forward.
Okay, so four big banks. You can choose black, red, white, green. Which one do you like as a long?
Currently Westpac. I think the balance sheet is probably the cleanest. When you look across all the other banks, they have less issues, ongoing issues. Mm-hmm. So I think Westpac at this point in time, if you're looking for a quality bank, that's the one to pick.
Probably ANZ's the key pick here, and I guess the reason for that is Shane Elliott's made it very clear that he's looking to fix the mistakes of the past. They're getting out of Asia. Sure, it's a hard road ahead. It's going to be quite a volatile path, but at least they are actually looking to wind back the balance sheet in Asia. And I guess with that comes actually quite strong capital generation. So if anything, it could be a left field surprise that ANZ's the only bank that doesn't actually have to raise capital if they actually end up generating enough out of Asia.
I'm choosing Westpac. The cleanest book, the best provisioned, and fundamentally will have a higher net interest margin and lower bad debts through the cycle. They're just a much cleaner bank than the Melbourne banks, ANZ and NAB.